Welcome to the Put Path, episode 2. Today we're going to go over how to set up an options account. So you need to apply for a options trading account through your brokerage. In episode 1, we walked you through how to set up a brokerage account. Now the next step is to apply for an options trading account. This requires completing an options application. Every broker is a little bit different. Trade is fairly detailed. Robinhood is probably the lowest barrier to entry, and Fidelity is going to be the most formal in their application. I recommend a level 2 or a tier 2 account. This is going to allow you to trade credit spreads, which is what we want to do here. It's really all you need. But if you wanted to get into more advanced trading, you would need a tier 3 or level 3 options account, which typically allows you to sell naked, uncovered type positions, straddles, strangles, stuff like that. So, as part of the application, you should read the booklet, Characteristics and Risks of Standardized Options. So, I read this a long time ago. It's very long. Um, about 5 years ago, I went through the whole book, but it is very useful, especially for beginners. If you don't have the background, if you don't understand the basics, this is where you'd want to start. And it's a requirement, I believe, for most brokerages to read this book. So I would definitely recommend that. And it's linked in the website, as you just saw. So it's going to take you a couple of days to get your options account approved. The application needs to go through, and then you need to fund your account. And typically, you're going to fund it with after-tax dollars in a brokerage account. If you're trading in an IRA account, you can fund it with your IRA money. All right, so we're going to go through some concepts and some definitions, really basic, just to get you started. Um, so, what is an option? An option is a financial derivative. Its price is based on the value of the underlying asset. So QQQ is our standard example that we go over typically. So QQQ is a basket of about 100 different stocks. These are high-tech stocks. These are highly liquid stocks, and they're very common names, Apple, Amazon, names like that. So the underlying, in this case, is QQQ. The option is what you believe QQQ is going to do price-wise within a given amount of time. So, um, options have a future date, and the way that options work in the United States is you can exercise or get assigned options before the expiration date. So, at any time up to that expiration date, the option is still live and the price is moving. So another thing that's very important is when you see a cost that is $1, when you see a cost that is 50 cents, that really means $100 and $50 in this example. So you multiply the price of the option times 100 because the option represents 100 of the underlying assets. So when you're trading a option of QQQ, you're actually trading a block of 100 shares of QQQ. So credit spreads, they're formed by having a transaction, two legs simultaneously, where you sell one option and you buy another one of a similar type, and that creates your credit spread. In our case, we sell the put at a higher price, and then we buy a put that's farther out of the money at a lower price. That results in a net credit to your account. So this strategy eliminates the unlimited risk that occurs when you sell a naked option, whether it's a put or a call, because you're buying that far out of the money insurance to make sure that if it goes really far down, or in the case of a call, really far up, you would be buying protection against a black swan or a Six Sigma type of an event to the upside or the downside. Now, for us, we're worried about the downside. So we buy that put far out of the money as protection. So we also sell within the same calendar serial or the same vertical time frame, which means that our expiration dates are the same. You can play around with different strategies. You can have diagonal spreads. You can use, um, you know, different expiration dates to set up different strategies. But we have a very simple way of viewing things here. What we have is the same expiration due date that allows us to focus on capital efficiency, on laddering our trades, and getting them on and off in the same week, which frees up additional capital to go and place another trade. So we use the same week, and it gives us 52 times a year to trade. Originally, I was trading some monthly underlyings and things of that nature, but it's really more advantageous for us to use weekly credit spreads, which allows us to trade more frequently, and you have a higher chance of hitting that 85% profitability target when you're trading more frequently. You have more, the law of large numbers comes into play. You have more opportunities, and you're going to be trending towards that 85% probability of profit. So that's why we go for the weekly trades. Okay, so it's also important to realize that approximately 70% of options expire worthless. So when you're buying an option, in totality, in the whole options universe, about 70% of those options that are purchased are worthless at the end. So with that backdrop and with that knowledge, we know that being in a selling position, which is what our primary profit driver is, selling those options are much more highly probabilistic and profitable. So let's walk through an example. If we are trying to set up a put credit spread, now you also have to think about the counterparty. What are they trying to do? He or she is buying a put and they're thinking that that stock's going to go way down, and or conversely, they would be buying a call thinking the call's going to go way up. So most people who trade options are gamblers. They're looking for the next big stock before it makes a big move up, right? So what they're doing is they're trying to um, time when XYZ stock is trading before it makes a big pop upwards. So for example, let's say XYZ is trading at 100. They think the stock's going to go up sharply in the next 30 days. So they might buy the 105 call option 30 days out for $1, which is $100. So there's basically three outcomes of that. If the stock stays below 105, they lose their dollar. If the option is partially profitable, the stock would need to go up between 105 and 1 cent to 105 and 99 cents. So let's say the stock goes up to 105.49. The long call option would receive that 49 cents as a profit. However, they paid $1. So you have to subtract out what they paid. So $1 minus what they paid is actually a $51 loss. So if that stock were to close at 105.49, they would actually lose $51. Okay. So the alternative option is the stock does go above 106, which is what the call purchaser is wanting. So that makes their trade profitable. So they would be at that point making money. Anything over 106 before 30 days makes them money. So they're gambling that the stock is going to go above 106 and they want it to go really far above 106. So let's say it goes up to 109, they would make $3 times 100 shares, which would be $300 basically. So, um, the way that works is that 109 minus 105 is 4. and then the premium that they bought it for is 100. So they would lose that 100 and they would end up making $300 net. So on the call side, that's where most people trade. That's where a lot of the gamblers trade. That's where it's kind of easier to understand. On the put side, everything I said is just in reverse. So the reason that we trade puts is because there's a lot of advantages. The market is got a lot of put skew typically. The pricing is more advantageous on the put side, and we just find that the market is continuing to grind higher and higher. The bull market is basically perpetual. So you don't want to find yourself fighting that bull market. So on the call side, I've traded a lot on the call side on, um, strangles, iron condors, things of that nature. I always find myself fighting that call side, and it is just the unprofitable side more often than not. So let's take an example of a put. So on the put side, we'd like to sell the 12 underlyings that I'm going to go through throughout this training. Um, let's take an example of DIA. DIA is our Dow Jones Industrial Average. It is a moderately liquid underlying, and it replicates the Dow Jones. Let's say we look 28 days out. We find a put option that has 85% probability of profit. Let's say the Dow is currently at 465.35. Okay, we look up the 85% probability of profit option, which could be, let's say, 445. So we would sell to open the 445 and buy to open the 440 for the downside protection. We use $5 wide spreads. In this example, we would sell our put for 470, and then we would buy our put option for 430. So that's a net credit of 40 cents, which is really $40. So that $40 goes into your account. Now, if DIA stays above 445 over the next 48 days, you get to keep that full $40. That's it. That's the whole system. I mean, I'm going to talk you through all of the details on capital efficiency and underlyings and laddering and all of the details, but that's really as simple as it gets. So put credit spreads in a very simple way that beginners can understand. That is exactly what this website is all about. So this may seem a little bit complicated to you, and if that is true, go ahead and read that characteristics PDF that I linked you to, and start to go through each of these put path steps, step by step, strategically and specifically as I've laid out. And I'm going to teach you how to trade these options profitably. We're also going to go over more advanced concepts. We're going to go over statistics, and I'm going to go over the math on how I created the system to make it um, highly probable for profit, and get you more engaged in some of the details. But this episode really was to have you at least understand the basics and get you started with reading that characteristics PDF guide, and also setting up your approval for your uh, options trading account.